pulling the short straw for Jane Fraser at Citigroup was Kristen Bitterly. They said, Kristen, go out there to professional organizations and help them try to get to retirement. Kristen Bitterly had a wealth at work at Citigroup. How bad is it? You walk into a fancy law firm, they're hiring Citigroup. What percentage of partners, associates, what percentage are behind the eight ball?
Well, I would say the good news is that we have been covering law firms for over 55 years. So we're celebrating our 55th anniversary just in a couple of weeks. And so we have long history working with over 900 firms, many of the AmLaw 200 firms. And so I think where we're involved, the strategy has always been we're following people through their career journey, starting from entry-level associates through to senior partners.
Yeah, but how many are behind right now? Alicia Manel would say, Roger Ferguson would say, we've completely screwed this up. How many fancy people at fancy law firms are behind the eight ball?
I'm going to offer another angle on this. I would say not behind, but I think what happens is we don't teach financial literacy in this country. So what we see very commonly, whether it's at law firms, whether it's at corporations, whether it's at professional services firms, you're someone who's been focused so much on your career, so much on your family, and then you basically find yourself in a situation where you have all of your savings in a savings account and you're underinvested. So the question there is, it's never too late to start, but the first thing you have to start with is making sure that, one, do I have the right estate plan in place? Only 1 out of 3 Americans have a will in place. And 2, do I have a financial plan? Only 1 out of 3 Americans have a financial plan in place. So when you combine that, Tom, with your question around, okay, retirement assets, you have around 67% of Americans with some type of retirement asset. However, only 30% feel prepared. So there's a big
70% of America, 70% of Sullivan and Cromwell, I'm just picking on them. I mean, Paul, it's amazing.
I know.
It's like the national topic.
It is a big topic. So where do you start? If you have your initial meeting with a client, where do you start?
So you have to meet them where they're at in their journey, first of all, and it's never too soon to start. So the reason why a lot of people fail to plan is they think they're not wealthy enough, they're too busy. We could come up with all of the various excuses. And so early on in your career, it's really creating that financial plan to say, when can I be prepared to buy a house? How am I thinking about taking on debt to do that? A lot of purchases, this is another kind of shocking stat, 70% of purchases are emotional. People will go in and buy a home.
Or a Vespa.
Or a Vespa, yes, Tom, that too. I saw that photo. That was great. But I think, when you have that plan and you kind of then say, okay, where should I be investing? How should I be maximizing certain accounts? How can I take advantage of actually the structuring and planning? So we talk about financial literacy within this country, but we've also added a lot of complexity in the sense that...
Come on, okay. Orzag's over at Lazard now. When he was at Brookings, he said, look, we got to do an automatic buy-in on 401k. I mean, that's all there is to it. Are we getting anywhere nearer to where we approximate Paul Sweeney's ginormous multi-8-figure 401k?
I mean, look, I think one of the other data points that is important is I do think we're getting closer in the sense when you look at the boomer generation and you look at the anticipated wealth transfer that we're going to experience over the next 2 decades, it's anticipated it's going to be $90 trillion. Over the next 20 years. So there is massive wealth creation and generation for those who are homeowners, for those who have exposure to the stock market. Clearly there's been benefits within that, but I think the key thing for our clients is the unifying factor is they're busy professionals who are trying to make it in their career and they're trying to take care of their families simultaneously. And sometimes what's best for you takes the backseat. So just taking that moment to come up with a plan and discipline, you will be way ahead of the game.
What are you telling your clients these days about where to go? Stocks, bonds, alternatives. I mean, the market's had a great year this year. Bonds have actually had a positive return. What are you telling them about these markets?
So the first thing is, I think when you're looking at what could drive markets, right now you could say the economy, you could say elections, you could say earnings, and geopolitics to a certain extent. I think there's a lot of people trying to trade around elections. Our advice is policy, not politics, is going to drive markets. So we are not making any significant portfolio changes on the back of that. I think there are, and I know a lot of people have been discussing this, there's always an excuse not to invest. There's always something to be worried about. But when you look at the tailwinds that we have right now, cash on the sidelines, $6.5 trillion. You have a Fed that, okay, whether it's another 25 basis points, 225 basis points, they are cutting rates. They're strengthening the consumer based on stock market prices, home prices. So I think there's actually a lot of positive tailwinds for risk assets.
Kristen Bitterly, with your experience at Citigroup, what's the level of exuberance right now? I am thunderstruck by the lack of taxi cab talk over what do I do with NVIDIA. I don't see, and there's some mathematics on this.
Either.
Yardeni and others have said, look, the exuberance just isn't there. When you go into a given institutional client to do wealth at work, are they foaming at the mouth to buy the Mag 7?
No, I think they're looking actually for much more balanced approaches to it. I
But
think
will that balanced approach get it done?
So what I will say is it's better than not being invested. So
Fair.
the first step,
Fair.
get invested, right? You could have a debate around passive versus active. It's first, being invested is better than not being invested. I think when it comes to the balance of conservative assets versus risk assets, you've seen a skew towards cash. With rates where they've been, massive skew towards cash. So that's another common conversation. Let's shift some of that risk profile.
David Balin was at Citigroup and he aged. David Balin aged because everybody stayed in cash. He said, Tom, I'm pulling my hair out. I mean, how do we get from where we are to optimism, to enthusiasm about owning a balanced SPX portfolio, even away from Microsoft?
I think you have to get away from the market timing conversation. You and I have talked about this, and it is something that market people believe. Just like I said, there's always a reason not to invest. There's always a reason that there could be a risk. It feels good to stay in cash on the sidelines. But look, if you stayed in cash on the sidelines year to date and you miss this 20% plus rally within equities, you are significantly underperforming. I think another thing that is actually a really positive, we talk about this all the time, longevity. People are living longer. The population over 80 is expected to triple. The population over 65 is expected to double. What does that mean in terms of how your money has to work for you? It has to work longer. So it's not just about risk assets, it's actually about, and your previous guest spoke about this, alternatives as well.
Yep.
You need those assets to work harder for you.
That's why I'm still working. How about you go to some of your associates at some of these law firms? I'm guessing they have a lot of debt that maybe we didn't have from education. That's got to make it tough on the younger folks.
I think it makes it tough on younger folks in all industries. And so you have to look at your balance sheet analysis. And I'm bringing this full circle to planning, looking at looking at the interest rate on that debt. Not all debt is bad, right? I mean, if you were someone who locked in one of those 30-rate fixed mortgages, like you won the lottery. So looking at debt not as necessarily bad in and of itself, but in terms of high rate, low rate, and trying to optimize your balance sheet, and then finding liquidity for where you can invest and where you can make those important investments for your family as well, such as owning your home.